Have you ever wondered what inflation exactly is and how it's measured? You're not the only person wondering about it. There are many more, and I have good news for you. You are about to find out what inflation is. Inflation, that topic so popular in the news that everybody is talking about. What is really inflation? Inflation is nothing more and nothing less than an increase in prices. And actually, inflation it's not a new topic. It's been around us ever since money was invented. But what drives inflation? Is inflation good? Or is it bad? And what are the risks? Well, about all of that we're going to talk here, so sit back and get comfortable. One of the main questions around inflation is how is inflation measured? To measure inflation, you take a basket and you put into the basket several goods and services for you to keep track of the prices of those. What are those goods and services? It can be anything. Can be bread, or price of milk, or 1 kilogram of tomatoes, or a brand new car, a brand new couch, your housing costs, or the petrol price, the insurance of your house, or the insurance of your car, your medical health insurance, or your car mechanic bill. You got the idea, right? Now, these prices they don't always stay the same, which means they fluctuate. So to keep track of it, you take a look at this basket periodically and compare the current price with the previous price. And this way you see by how much those prices changed. The most common inflation figure is the yearly figure, and the yearly figure tells you by how much those prices have changed since exactly 1 year ago. The big question around inflation is what drives inflation? Or what makes prices go up? Well, there are three factors to count in. And the first one is production costs that factories have in order to manufacture the products. Secondly, supply and demand of those products. And thirdly, the monetary policy of central banks. Let's go back to production costs. We said that production costs are the costs that a factory has to manufacture its products. Let's assume for this example purposes that all factories in the world have higher costs to manufacture their products. If all factories have higher costs to manufacture their products, in order to stay profitable, what they have to do is to increase the selling price of their products. And if they all do that, as overall they drive the prices up. Why could a factory have higher costs? Well, in one hand we have the raw materials and fossil fuels such as petrol, gas or electricity. The prices of those fluctuate and sometimes there are significant increases. The crude oil is the major leader of price changes. If crude oil increases, the impact it has is big because crude oil is used not only for petrol but also to make other products like for example plastic. Therefore crude oil is very closely watched. Of course, raw material are also taken into account such as wood, heavy metals, cotton and so on. Another factor that influences production costs are the personnel costs. The staff of a factory can go on a strike for several days, demanding higher salaries, and if successful, personnel pay increases. As a result, the factory will be facing higher production costs. The next one on the list is supply and demand. When we say supply and demand, we refer to market dynamics of supply and demand of goods and services. What are those dynamics? Well, more specifically, the buying pressure versus the selling pressure. Let's take for this example purposes the electricity market or the power market. For the factories around the world to produce and keep on producing, there must be a continuous supply of electricity from power plants to the electricity users, in this case a car factory. If for whatever reason the power plants cannot keep up with the demand of electricity, the price of this will immediately go up. Why? Because there are more buyers than sellers. So the buying pressure is higher than the selling pressure, therefore pushing the price upwards. Another example of this market dynamics is olive oil. For olives to grow nicely, you need rain, and if it doesn't rain, olives don't grow. And if olives don't grow, there is no olive oil, and if there is no olive oil to meet the demand, well, prices will obviously go up. At last, we have the monetary policy. And the monetary policy has to do with how central banks influence the value of the money with the set of tools they have. Central banks can make money to increase in value or decrease. They can even create inflation if they want. Yep, that's right, they can create inflation. But how can central banks create inflation? One way to create inflation is by lowering interest rates to stimulate credit. This is a little bit more difficult to explain quickly. I have a different video where I explain it in more detail, but let me try. So in one hand we have the banks, and in another one we have the factories and households. If banks lower the interest rate on credit, loan and mortgage, households and factories will go to the bank to borrow more money because credit is cheap, or at least that is the intention. The banks lend money to the factories and households, and now these have more money to spend or invest. Spending on what? Households will perhaps buy a new car, or even a secondary holiday house. And what about the factories? Factories will have more money to open another factory, and so on. This new money being spent will be creating buying pressure in the economy. And what happens when there is more buying? You got that right, prices go up. There is one more way how to create inflation, and it's when governments print more money to pay for its debt and government spending. That happens when a government cannot or doesn't want to issue public debt. However, this is like shooting yourself in the foot, because if they print more money, the value of your currency will decrease in comparison with other currencies, and that will make prices to go up even more, entering a spiral of uncontrolled hyperinflation that is very, very difficult to get out from. Example of this type of monetary policy, there are a lot, but most representative at the moment is perhaps Venezuela or Argentina. These are the most important factors to contribute in inflation, but there is still one question left. Is inflation good or is it bad? Well, it depends. There is scientific observation that show that a constant inflation of 2% a year is good. It means the economy is running well and growing slowly. If inflation is significantly higher than 2% for an extended period of time, like we had in 2022, and your income also increases equally as the inflation does, then inflation is not so bad for you. When is inflation not good? Well, let's take the same example as previously, when there is an extended period of time with high inflation, but your income this time stays the same. In that case, you will experience a loss of purchasing power, and that is not so good for you. Important to note is that it's exactly this loss in purchase power that plays against cautious people that keep savings in cash, and over time the money they keep will be worth less and less and less. How do you protect yourself from inflation? Well, you can protect yourself from inflation by investing your spare money in a diversified portfolio of assets. If you want to know more about what diversification is and why it's good for you, I have another video where I explain it in better and in more detail. If you think this video was useful, give me a thumbs up so I know you liked it. See you in the next video, and don't forget to subscribe here. Ciao!